My name is Tasha Sanders. I am the lead business counselor as well as the facilitator at the ODU Women's Business Center. And today we will have Ms. Sabrina Davis from Fulton Bank. She is the Vice President of Banking, the Vice President Banking Center Manager of Fulton Bank here in Virginia Beach off of Bonnie Road. And today we'll be working with the workshop of knowing the difference between your business credit and personal credit. So I wanted to go over a few things while we're waiting on other people to get in. Right now it's 10:02, so we're going to wait until about 10:05. All right, so we do have an Engage in Entrepreneurship, which is a women's business center orientation, and also going over the Small Business Administration web resource training today at 2 p.m. So I would suggest, if you want to know a little bit more about what we do as the Women's Business Center, if you can register for that, I'll go ahead and set that link into the chat. That is available for you to go ahead and register. That is today at 2 o'clock. We will have those orientations every week from here on out. Also next week, there will be another workshop that Ms. Sabrina will be doing, and it's how to finance your business venture. So let me put a title in here. I hope I spelled that right. If it's not, charge my head, not my heart. All right, so that's the link for that. And then the next workshop is going to be on the 16th. It's how to finance your business venture, and that will be on February the 16th. So if you can also register for that one, same time at 10 a.m. But the Engage in Entrepreneurship will be at 2 p.m. today. So today's session is recorded. If you have not already done so, we do have a YouTube channel where all of our videos will be uploaded or have been uploaded. So you can actually go I'm trying to get the ODU Women's Business Center's channel. Give me one quick second. And of course, now I can't really, oh, here it is. And that is to our YouTube channel. That's where all of the video sessions that we have, all of our workshops, the previous workshops have been uploaded for your viewing pleasure. So if you can check those out. So welcome everyone, welcome, welcome, welcome. So we have, and Sabrina has actually put her contact information into the chat. So we have Nicole Mitchell, do you currently have a business? Okay, pronounced Rashini.
I do not.
Okay.
I'm interested in getting assistance to start a business.
Okay, so make sure if you are not able to actually come to the orientation to find out more information, I'll also put my link in to the chat to schedule a one-on-one consultation with us so that we can actually kind of help you out and point you in the right directions. We have plenty of workshops going on with the Women's Business Center that are mainly free. A lot of the workshops this year are free. I'm going to, let me see if I can get my link here to work. And that's to schedule a virtual meeting. It's a 30-minute session so that we can actually do one-on-one consultations with you. That is a link there. So we have a coaching business, Shiptown Botanical. Okay, so you do cut flowers. And then we have daycare. There is Latasha, I'm going to reach out to you after this. I know we have something going on that I know there's something in the works they're trying to do with daycares in the area, because, you know, a lot of stuff has happened. Of course,
yes, a lot of closures.
So,
and I just scheduled a consultation when you put the link in for next Tuesday.
Okay, good.
Okay. Nice to meet everybody.
All right, Ms. Woodley, I see you from the ODU, from not ODU, but from Slover Library, the Business Center. Very good. All right, Smith Insurance Group, and we need that, especially business owners. So make sure you have your bell, it's your banker, which is Ms. Sabrina. You have your accountant, you have your insurance agent, and you have your attorney or your lawyer. So you have your bell group. Let's see. All right, and homeschool education consultant. Very good. So Sabrina, we have a variety of women here today. So,
we do. It's exciting.
Very good. So I'm going to go ahead and turn it over to Sabrina, and you all enjoy the presentation.
Thank you so much, Tasha. I appreciate the warm welcome, and welcome everybody. As Tasha had mentioned, I'm the Vice President at Fulton Bank, and I'm so passionate in helping business owners and anyone for that matter when it comes to education and being able to take that information to the next level and helping you through your pain points of running a business, or even just thinking about starting a business, or all of the above. And thank you so much. I'm super excited that everybody is here today and being able to spend their valuable time, whether you're at home or you're at your business or place of business. Thank you so much for your time today, and hope that you find this information very valuable. We're going to take a journey this morning, and I want to take you on a journey to help with the understanding of what's the difference between your business credit score and your personal credit score. So I am sure with as many as we have online that there are plenty that would be able to articulate their experience of being able to apply for a loan. And there's probably some good, some bad, some ugly, all around the spectrum of experiences that you have had when you're applying for a loan. And one of the challenges that you may have faced or you may face is understanding the importance of your personal credit score as equally as important as your business credit score when you are trying to apply for a business loan. And for that matter, if you're trying to apply for a personal loan as well. Of course, the business credit score doesn't take place. But so what I'm going to do is take you down the road of what the bank thinks. What are they looking at? What are they thinking when they see certain ideas? And I want to also give you some additional resources to be able to leave here today and put some things in place to help you monitor what's going on with your credit score. So the first module, we're going to talk about what's the 5 different algorithms of your credit score and how does it all equate. As you can see, it's up on the screen. I'm going to start from the beginning in just a moment, but when I do, I kind of lose being able to toggle from screen to screen. So I just wanted to bring that up. You can see the 5 different algorithms, and most people are thinking, well, 35% payment history, 30% available credit. All right, Sabrina, this is a 2-hour seminar, so that's pretty self-explanatory. However, there's a lot more to know. and we're going to dissect each one of these algorithms. I'm going to help you understand them better, explain them, coach you through it with additional resources, and help you make your score better, whether it's challenged right now and you want to fix it, or if it's really good right now and you want to keep it that way, but maybe you're wanting to help somebody in your family or a friend or pay it forward, or whether you're a coach, business, these are things that you can help and pay it forward with everyone that you come in contact with, because there's a lot of misinformation out there to be able to help people with their, and understand what your score is. And I think they come from a good place. They want to help people, but if you're getting wrong information, that's not really helping you. So this additional time that we're going to spend together is really taking you through the understanding of all those details. You're going to find a couple of things going on as you're listening to this presentation. You're going to be like, oh, wow, big aha moment. Now that makes sense. And if I can add one of those moments to your life today, then I've done my job of being able to teach this material so you know how to better use it and utilize it. You're also going to have a moment you're like, wow, I didn't realize that. Somebody else told me something different. And it's going to clear up any misperceptions that you have. At the end of this presentation, what we're going to do is we're going to have Tasha join us again, and through the chat room, be able to answer any questions that you have. And before we move on to the business credit score part of the presentation. So thank you, Tasha. You're always amazing. I appreciate your help. Unfortunately, when I have the presentation up, I can't see the chat room, so that's where Tasha is helping me. Tasha, please feel free to jump in at any time. Maybe we take a 5-minute, okay, let's question and answer, and then go on to the next part of the presentation. I'll leave that to your discretion, whatever you feel is best. So, you know, when Tasha was talking about your bail team, a couple of things that I really want to bring to the table before we get started. Just thoughts, if you would. As I mentioned, being the assistant vice president of Fulton Bank, I've been a financial advisor for over 24 years and have had a lot of experience. And in my experience that I see some businesses that fail during my journeys through my career. And one thing that breaks my heart is when they tell me the reasons why they failed, that we could have probably put that on the table up front if they had just known and discussed it and be able to help them. So we're going to discuss the top 3 reasons why businesses fail, so then you know what you know and then can put into practice things and resources like the Women's Business Center, like the Small Business Development Center, like the Veterans Business Center, Outreach Center. There's so many different resources, and I love the Women's Business Center because they do such an amazing job getting the critical information and material out for your success for your business. And one reason why I volunteer my time to do this. So as you think about the bail team that Tasha was talking about, I want to take a minute and articulate a little bit better, a little bit more, not better, because what she said was 100% spot on, but want to kind of take you down a little bit more to think about. So the bail team, right? At this point, I probably would have had it by a show of hands, what does the bail team stand for, to see if you were really paying attention. But that's okay. We're doing this by conference now, and hey, you're saved. No pressure, right? So I want to go back down that bail team. The BAIL, of course, what those stand for is the bank or the credit union, the A, the accountant, the I, the insurance, and the L is your lawyer. So critical to pick out the right bank for you and the right partner for you, because these are people that you choose. You're not dictated of who you use, right? You choose who you want on your team to help you be successful with your business. Now, no, they're not going to do it for you. However, they're going to roll up their sleeves and be a partner with you. So what I'm going to do is talk a little bit about the B and the banks and the credit unions and kind of give you some things to think about. So at the end of the day, all banks and credit unions are not the same. It doesn't make them a bad credit union. It doesn't make them a bad bank. It just means that each bank has its own business model. I mean, think about it. The business that you have, if we have any landscapers or landscaping businesses on the call, and you choose not to, in the wintertime, scrape snow off of somebody's driveway as an additional business plan that you have and additional resources to offer, or maybe you're just, hey, I come in and set up the flowers and do the trees and set up, doing the landscaping, but I'm not going to cut your grass. It's just not what I want to do. It doesn't make them a bad landscaping company. You just have to seek out, if you're looking for somebody to do landscaping and the flowers and the trees, you have to do some research, pick up the phone, find out who they are, do some pricing. If you want somebody to cut your grass, you got to pick up the phone, do some research, find out who's going to be the right resource for you. Well, that's the way I want you to think of the banks. They do different things. Some banks specialize in small business. Some banks specialize in SBA lending, small business administration lending. Some banks don't. Some banks don't even help small businesses when it comes to lending if you haven't been in business for more than 2 years. And it doesn't make them a bad bank. They just don't do it. They choose not to. Banks are risk adverse. They don't want to take on a lot of risk. So therefore, you got to get out and interview the banks. Find the right bank for you. If you chose your bank because, hey, I've been banking with them on the consumer level, I do all of my personal banking with them, then I'll just stay here. You may find later down the road it's not the right bank to help you with a business. But they've done an outstanding job on the consumer. And again, it doesn't make them a bad bank or a bad credit union. You just need to get in and to find out in advance. Because if you hang your hat at a particular bank to do your business and you've spent your relationship building that relationship in time and effort with your business checking accounts or business credit card, or you've just gone in and said, okay, give me a statement here and there, and okay, it's been 2 or 3 years. All right, now I need a loan. Well, how long have you been in business? Well, I've been in business about 1.5 years. I've had my accounts with you about 1.5 years. Well, I'm sorry, if you haven't been in business for more than 2 years, we can't do your loan. So how much time have you wasted to figure out, is that the right bank or credit union for you? And then now you got to start all over again. You're like, daggone, if I'd have just known. So the top 3 reasons why, in my opinion, over the 24 years that I've been doing this, reasons why a business has failed in the past, and hopefully it's been, a very small amount of people that have failed. But what I've done is I've done some research, and this is what they've told me. The top 1 reason, I just didn't know what I didn't know. So if I'd have known that I needed to go and research a bank and find out and find the right bank for me, then I would have done that. Or I've had some challenging credit issues. No judgment, right? But you can never speak into somebody's life of why they might have a challenged credit score. And it may be medical expenses. It may be unexpected job loss. You just don't know. It could be unexpected divorce, who knew? And if I'd have just known that my personal credit is just as critical when I'm applying for a loan as my business credit, I just wish I'd have known. So they just didn't know what they didn't know. So as I mentioned, thank you so much for being on this call today, because you're going to find out a lot of the things that you probably didn't know that now you're going to know. And that's why I love the Women's Business Center, because they give you that information. They consult with businesses all day, every day. They hear what's going on. They know your pain points. And then they really care to bring the material to you to help you understand what you need to know so you don't fail. Or that you're starting up and you're putting the right resources and have all the information up front. So the second reason why a business might fail that I've seen, lack of planning. If you fail to plan, you plan to fail, that old chestnut. Planning is really important, whether you're a startup business, thinking about going into business, or you've been in business. A business plan, in my opinion, is very critical to the success of your business, and I'll tell you why. It's your roadmap. Think about it. If you get in your car and you're like, hey, I think I'm going to go to California. Let me get in my car. I've packed my bag. Let's get on it. And you get on the road and you don't have a map. You don't have GPS. You don't have MapQuest. You don't have OnStar. I mean, there's so many different things that you could put in place that can help you get from A to B, right? But you don't use them. How are you going to make sure you successfully end where you want to be? What's gonna get you from A to B? And a business plan is quite simply your roadmap. It talks to you about advertising. It talks to you about who's your competition. It talks to you about, okay, running these numbers to make sure that I've got it down. So when I get with my CPA, I know what I'm doing. It talks about who your employees are going to be. It really helps you fine-tune what you need to know to go in business or to start a business or even thinking about a business, or even if you've already started a business and you have a business plan, that's great. Go back. It's a breathing, living document. It's not a one-time set it and forget it. You want to continue working on that business plan, because let's say you were that landscaper and you're like, okay, I'm not making enough revenue or sales just by doing flowers and trees and putting in landscaping. Now I need to add additional part to my business plan. I need to go ahead and put a cutting grass component. So it helps you put those thoughts to paper, because at the end of the day, if you're looking for a SBA business loan and you're a startup business or you don't have enough generated revenue, a small business administration loan is where we would need to go. And guess what they require? A business plan. When you go to the bank and they're like, okay, we probably need to do an SBA loan, and you're like, okay, great. The next thing they're going to ask is, have you done a business plan? And if you haven't, you got to start there. Hey, I wish I'd have known. I would have done my business plan. Well, you're on this call and now you know. So planning. You didn't know what you didn't know. The number three, the third reason is lack of capital. So when I talk about lack of capital, how much money should you have for your business before you start? How much money will you have to have in order to apply for a loan? What is that magic number? If I have $50,000 and I know that it's going to take $50,000 to go in business, should I just use my whole $50,000 or do I use bank money? So here's the beauty of being on this call today. That's next week's session, and we call it the 8 C's of credit. I'm going to help take you on a journey of understanding what you need to know to apply for a loan, what types of loans are out there for all banks and credit unions, for some, I shouldn't say for all. What are all the products and services out there to help you get your funding for capital, working capital, and how do you prepare yourself to apply for that loan? So as I'd mentioned, been doing this for 24 years. And we're talking about the bail team, the banks, the credit unions, and how they're all different. So I'm going to give you commercials from time to time, not because I'm trying to sell you something. I'm giving you an idea of what's out there so it can articulate and kind of drive home the message that I'm trying to relay to you and being on this call. So you've got large banks, medium banks, small banks, and then you've got credit unions, right? Well, I advise you to interview one of each, a credit union, large, medium, and small bank. Fulton Bank is a medium-sized bank, and we are amazing when it comes to helping small business owners. You know, so much so that we have unique products and services. We're a premier lender for SBA. We specialize in helping startups, and we're very passionate for veteran-owned businesses. So that's just an example of a medium-sized bank. Please come interview me. I'm happy to sit down with you, whether it's a conference or face-to-face, and see if Fulton Bank is the right bank for you and talk through what's going on in your journey for your business. Because at the end of the day, whether you choose Fulton Bank or not, I care about your success and your business being successful. And if I can at least point you in the right direction, that's what I'm there for. So here we are, 27 minutes into the first hour. Let's go ahead and get started with our first presentation. So I had mentioned the importance of being able to understand your credit. And we talked about 35% in these 5 different algorithms. 35% goes to your payment history. 30% goes to your available credit. 15% goes to the length of history. 10% goes to the type of credit you have. And the last 10% goes to the inquiries that you have. Up at the top left-hand corner of your screen, you'll also see my card of information of contact. As Tasha had mentioned, you'll see that in the chat as well as I welcomed the group first thing this morning at 10 o'clock. And you can reach out to me by email, just quick questions or whatever. I also do credit counseling. So if you're trying to find the right strategy and come up with the right information of, you know, maybe you're one of those that are on the call that have challenged credit right now, please know that it's not the end all be all. You can take control of that and change it. And it could be a couple of little things and tweaks that you do that can help you with your credit. So I'm going to help you with understanding and the why behind it of these 5 algorithms. Then we're going to go into some things that you can put in place to try to change these algorithms if you happen to have a challenge in one of them. So let's go ahead and talk about a couple of things in advance before we talk about the first algorithm. Things I really want you to know. Credit Karma, credit unions, Bank of America, Capital One. I mean, there's so many different programs out there today that you can use as a resource to get a good idea what your score is. And I'm hoping that everyone on this call is using some kind of platform to just kind of check in and see what's going on with your credit score. I personally love Credit Karma. No, they don't pay me. I just love them. I've been using them for many, many years. And here's the reason why. Credit Karma talks about these algorithms. They help you understand where you're at in each one of those algorithms by soft pull. We'll talk about what's the difference between a soft pull and a hard pull. And it talks about 2 of the bureaus of the 3. I love it because it is a program to help you think through what your score is and help you manage it. Other ones just kind of tell you, give you an idea what your score might be, but they don't walk you through the 5 algorithms and help you stay in control of what's going on with your score. So this is where I need everyone to listen to me very carefully. I mean, I hope you're listening to me very carefully the rest of the time too. But anyway, if you're not listening to me at any other time, please hear me when I say this. If you're using one of the programs to help you understand what your score is, it is not your score. Let me repeat that. It is not your score. You're like, wait a minute, Sabrina, what's going on here? Well, let me explain it to you. I'm glad you asked. Here's what they do. They take a soft pull on whatever bureau that they are saying they're taking. And Credit Karma, as you know, does TransUnion and Equifax. And you can toggle between the 2. They're taking a soft pull. They're looking at every trade line you have, and then they're plugging it in to the algorithms that I mentioned and taking their best guess of what your score is. It is not your score. They're taking their best guess at what it is. They could be higher, they could be lower. Usually they're pretty close to within 20 basis points of what it is. So let me explain to you how you can get your actual score. The only way you can get your actual credit score is if you're applying for a loan, a line of credit, applying for a mortgage. If you are actually doing an application, the banking institutions and credit unions are bound by regulation to send you by mail what your score was from that bureau and 3 possible algorithms that you can work on to make it better and stronger. You can have an 830 score. They're still going to give you an idea of something you might be able to work on to make it stronger. Well, wait a minute, Sabrina, Bank of America told me this is my score. Well, no, what they're using is a platform and a program to help take their best guess at what your score is. It is not your score. Why are they telling me that's what my score is? I don't know. I don't know how they get away with it. It isn't your score. They're just taking your best guess. I don't know why it's not regulated that they can use that verbiage, that they should say, look, this is the best guess of what your score is, instead of this is your score. So anyway, I wanted to clear that up. Moving right along. All right, so that explains why is my score in the Credit Karma, as an example, different from the bank score when I just applied for the loan. And that will explain to you why, because that's not your score. So the 3 bureaus we're talking about is Equifax, TransUnion, and Experian. Those are the 3 bureaus. You can actually get in touch, and it's annualcreditreport.com. Tasha, you might want to put that in the chat room. It's annualcreditreport.com is the place that you can go and get a copy of your credit bureau. It will tell you your trade lines. It will tell you your AKAs, also known as names. It will tell you your past history and addresses. And please dispute anything that you're not aware of, so they can make sure that they've got it corrected. They usually charge you, but they give it to you one time per year for free. Right now, because of COVID-19, they have actually given you it for free as many times as you need. So you can ask them to give you a copy of your bureau. Unlimited right now, so take advantage of that, especially if you're trying to repair it. Because of COVID, what they've done is allowed the bureaus to be pulled as many times as you want to be able to give you what your trade lines are. But keep in consideration, it's not going to be your score. They're not giving you your score. They're just giving you your credit bureau and what's on it. Are you late? Have you been on time? But it's not going to give you your score. Remember, the only way you can get your score is by applying for any kind of application, loan, credit card, anything like that, a mortgage. They have to, and we are regulated to send you who we pulled and what the actual score was that they reported to us. So wanted to kind of take a minute and stop there. Tasha, are there any questions that you can see in the chat room at this point?
There was only one question, and that was from Rashini. That was Fulton Bank in Norfolk or Virginia Beach? And my reply was Fulton Bank has 5 Hampton Roads locations, 2 in Chesapeake and 3 in Virginia Beach. And you can correct me if there are additionals.
No, that's great. So they were asking about the locations. Is that what they were asking about?
Right, if Fulton Bank was in Norfolk or Virginia Beach.
So Virginia Beach, yes, we've got 3 locations. Norfolk, we're not, but I take care of Norfolk clients as well. I am at the Virginia Beach. I'm at the corporate office. Come see me. I'd be happy to, talk to you about a strategy, or even just kind of just discuss with you what you're looking to do and your thoughts with your business. Or if you have more of a detailed request, just let me know and we can point you in the right direction. But yes, and then just to piggyback on that, and thank you so much for asking, we are in 5 states: Pennsylvania, Delaware, New Jersey, Virginia, and Maryland. So Ms. Tasha, anybody else?
Yes, I believe the question is the first reason that most businesses fail. Latasha, do you want to unmute and I think that was.
Oh yeah, sorry, I got the one about the business plan and then the lack of capital, but I missed the first one. I was taking note.
Okay.
Well, thank you for being the second question.
Okay, you're welcome.
And thank you for the first question. I appreciate that, stepping out there and being, brave and all. But Latasha, thank you for asking. And the answer to that is the customer just doesn't know what they don't know.
Gotcha.
And
Thank you.
You're welcome. So happy that everybody's on here because you'll find out as we go through this week's presentation and next week's presentation, you're going to be like, now I know. And it'll make sense. Thank you. All right, Tasha, I think with that, we'll move on. All right. So the last thing I want to bring up is if you are a partner in a business, let's say you're husband, wife, or partnership, and somebody owns 50%, the other person owns the other 50%, or if you own 49 and the other person owns 51%, be careful who you go in business with. Because let's say your credit score is fantastic, but your partner's credit score is very challenged. Someone's good credit does not make somebody's challenged credit good to get approved. So if you're asking for a loan and you're more than a 10% owner, you need to have that conversation about what their credit score is. Because you may decide if their score is challenged, hey, maybe I bring them on as a partner later once they get all that cleaned up. And again, remember, there's no judgment. There could be all kinds of reasons why the credit is challenged that was really out of their control. But they need to fix that first. And then if you're applying for a loan, of course, and the credit is challenged, we got to fix this first. So let's move on to how can we fix it and what are the different algorithms of my personal credit score. So 35% goes to your payment history, right? Most people think, well, okay, that's if I pay on time or if I pay late. Well, that is true, but there's more to it. I want to take you down this journey, sorry about that, of this particular algorithm. I'm going to give an example. So let's say you have $10,000 judgment that's 3 years old. That's going to weigh less than your Pizza Hut collection that you just paid off from 5 years ago for $14. Well, Sabrina, that doesn't make any sense. $10,000, obviously I owe more. Why would the $10,000 judgment hurt me more than the $14 payment that I just made to my Pizza Hut collection because I'm just trying to get rid of it? They wouldn't go away. I disputed it. I really didn't get the pizza, but they put a collection on me. Why does that hold accountable even stronger for the $14 than the $10,000 judgment that I just paid? Well, the reason why is because this algorithm is based on date of last activity. What you need to keep in consideration is this is a computer, not a human being. It is only going to give a score based on how you handle your credit and how it's reported. So that $10,000 judgment's 3 years old. It's stopped noticing it. You could have a 700 score and a $10,000 judgment that's been 3 or 5 years old. And you're like, well, why? Because it's been sitting there and you're not paying on it and it doesn't see that judgment at the moment. As soon as you pay it, your score is going to plummet 35%. And you're like, well, I think I'll go in and apply for a loan before I actually pay this off. Well, unfortunately, that's where the human being comes from. When you go in and you apply for a loan, the first thing that we're going to do is pull credit, and we're going to see that you've got that $10,000 judgment. And you're probably telling me, well, my score is 700. It's all good. Yay. And then we pull the score and we're like, no, there's a $10,000 judgment. You got to pay them before we give you more. Because at the end of the day, all a score means is trust. To the bank, we are thinking, can we trust you? Because all we want to know is, can we trust you that you're going to get and pay us back? We want to know if we're going to get our money back. At the end of the day, all we want to know is if we're going to get our money back, right? So a score, it does not mean, oh, you're approved or declined, because there's more to it other than just getting approved through a credit score. This is just part of it. And next week's presentation is going to break down all the different 7 other things that go into an approval or decline of a loan. Please come back and do that session as well. So the score just means, can we trust you? You know, like I said, there's no judgment. It's just whether or not it makes good business sense to give you a loan, and whether or not we know for sure, beyond a shadow of a doubt, that you're going to pay us back. So we may see a couple of blips on there and we're like, okay, the score is a little challenged, but yeah, that's good enough. And then it may be that we give you an approval, but the rate is really high. Why? Because if there's risk there, it may not be a decline. It just may be, okay, we'll do this, but we're going to test you out. We can see that you haven't paid in a couple situations, but you cleaned it up. Everything looks good, but all right, we're going to charge you a higher rate. So keep this in mind. If you have a challenge score versus somebody that has a good score, the person who has the challenge score is going to pay so much more for the same debt than the person that has good score. And you just want to keep that in consideration. It's going to cost you a lot more money if your score is challenged. So of course you want to save money and keep that money in your pocket and get the best rate and be, you know, be the one that gets the low score. So just keep that in consideration. So what are some things that you can do? So here are some tricks to the trade I want you to know about. So if you are in a situation to where this algorithm is challenged, you've paid late, or you have a judgment or whatever, what are some things that you can do? Well, you can actually piggyback on somebody's good trade line. Well, what does that mean? Well, I'm going to give you an example, and this is actually a true example. My daughter was getting ready to get out of high school. The last 2 years, I actually called the credit card company and added her as an authorized user. No, I did not give her a card to go use. Although I trust her today, when you're that age, you've got some learning to do. So what I did was I helped her piggyback on my good credit by adding her as an authorized user to my card. I did not give her the card to use. I just wanted to help build her credit the last 2 years while she was in high school. So when she got out and went to college, and she did, then she could go get her own car and do her own credit. And it's her own responsibility, and mom did not have to co-sign for it and take on ownership of any of it. So I helped her build her credit, and she didn't even know it. Now be careful, because if I were to put my daughter at that age as an authorized user on my credit card, and I made late payments all the time, or I didn't even pay on time, then guess what I'm doing to her credit? I'm destroying it. So you can piggyback on somebody's good credit, or you can piggyback on somebody's challenge credit. So here's what happened. She went to college. Of course, I did get her a copy of that credit card as an authorized user, because I wanted to know that if she were to break down on the side of the road, or she needed to get back in her dorm or whatever reason, she had an emergency situation, I can make sure she stays safe, right? So that is actually what happened. She was on her way back from college to see me, yay, and she broke down, and we were able to get her home safely and tow her and have her fixed. Of course, I did threaten her life that if she misused that card, I was coming to get her, regardless of how far she was away. But again, I did trust her. So my point being, just because you have somebody as an authorized user does not necessarily mean that you have the authority to use that card, because it means that you don't, unless that person who added you as an authorized user calls and says, yes, mail them a card or give them a card as well. So it's a tactic and a technique that you can have somebody help build credit, or if you're in a situation you're having to rebuild credit, it's another technique that you can do that. So I hope that makes sense, and we're going to go ahead and move on. So the next algorithm is based on available credit. So this is your utilization, your credit limit, or your open to buy, minus the amount you owe. So what we're going to do is we're going to give an example of this. Let's say you've got a $2,000 limit on your Fulton Bank of America. Fulton Bank credit cards, yay. Let's say you've got another $2,000 limit on your Bank of America line of credit. And let's say you've got another $1,000 limit on your Capital One credit card. You know, so I mean, that all adds up to $5,000 that you can go all over around town and spend, right? Well, hold on. As soon as you spend $1,500 or more of that $5,000, you have plummeted your score by 30%. Very, very powerful. This algorithm and the first one, these two are the math daddy of your score. If you get the first two in a challenge situation, you've already got a challenge credit score. If you can't get the first two in line, the other ones are 15, 10, and 10, so not as impactful as the first two algorithms, but I go over them so you have an idea and what they stand for. So let me explain. Here's how it works. Once you go over 28% of your utilization, which in this example is $5,000, you've plummeted your score by 30%. You've got to stay at $1,400 or less. And you're like, well, what if I just, do $1,500 on my Fulton Bank credit card and all the rest of them, are under and I'm not using them at all? Well, that's why I gave you the example of all three credit cards. You're not going to be looking at your utilization for each card itself. You're going to be adding up all your limits and not wanting to go over 28% of that total. And that's, you don't want to, so the amount that you're looking at is 5,000. So what is 28% of 5,000? And that's 1,400. It doesn't matter which card you're using. It doesn't matter if you put all of the $1,500 on one card. What matters is you take 5,000, multiply it times 28%, or whatever number you have for all your limits, multiply that times 28%, and whatever that number is, don't go over it. If you do go over it, make sure you pay off the balance every month, because the algorithm will see that you're paying it off. And then if you use it again the next month and it's $1,500, make sure you're paying it off. This algorithm is only looking to see how you average your balances. So if you keep a balance of $1,500 or $2,000 consistently, your score is always going to be challenged. So here's something else I want you to think of. I'm the customer, and I hear this a lot. I'm the type of customer, Sabrina, that I don't use credit. I got myself in trouble using credit cards in the past, and I don't want to use them anymore, right? You're like, I don't trust myself. I don't want to use credit. If I need something, I'll just pay cash. And then you're trying to open a business, and this is an example of one of my clients, and they come to me and they have a loan that they need to ask for, and they paid for cash everything. He was about 37 years old, 37 years, just paying cash for everything. He was just not going to do it. He wasn't going to get in debt. Well, now he needed to, and he needed to be able to borrow for his business that he had paid cash for over the few years. Well, his score was plummeted. His score was very challenged. And it's not because he didn't use credit and he protected it. It's only because he didn't use credit. Because remember what I said, can we trust you? All the bank wants to know is if they're going to get their money back. And if you're not giving us examples that we can show that we can trust you and see how you're using your credit, then there is no trust. I mean, great, you had cash, you paid for it, that's great. But I don't know you. I can't see tangibly whether or not I can trust you. So if you're that client, you need to search deep and come up with a strategy to make sure when you are using credit to pay it off every month. And there are ways to be able to do that. And that's just coming up with a good strategy. And your banker should be willing to sit down with you and help you do that. If you're getting an experience of walking into the bank and you say, great, I need a loan. All right, fantastic. How much do you need? Oh, I need $30,000 for my business. All right. Well, have you been in business more than 2 years? Well, no. Well, I can't do the loan for you. Darn. So now you have to step back and find a bank that can. All right, well, you come to Sabrina and you're like, great, I need $30,000. I heard that you are very user-friendly with small businesses. And I tell you, well, how much do you need? All right, let's just apply. You should fire that banker. They need to find out what the money is being used for. Find out about your business. Get to know you. If you feel that your bank or banker is not rolling up their sleeves to have a conversation with you and to come up with a good strategy, fire them. Find someone else that does, because they're out there. They should be sitting down and saying, okay, what's the $30,000 for? Is this the right product that you're asking for? Are there any other options that might save you money? Let's talk about, okay, we got through that process. It came back declined because of credit score. Are you getting, I'm sorry you're declined, have a nice day, get out of my office? Or are you getting I'm sorry you were declined, and that only means not now, but how can we get you prepared to get it and fix this? That's the type of relationship that you're looking for. And somebody that is willing to roll up their sleeves to help you through the strategy of saying, okay, it didn't happen now, let's figure out how we can get you there. And the bankers should be able to do that. And then there are some bankers that are trying to coach or counsel you on it, but they really don't know what they're talking about. So now you know how to go in and interview and see if they're really knowing what they're talking about, because we're talking about the algorithms right now, and find out if they really do understand your pain points, your business, what you're looking to do, and if it is a challenge situation, how can they help you get over the hump? Because if you were somebody that came to me and said, look, I need an SBA loan, great, I heard you do them, fine, and you don't need a business plan, I would be helping you find the resource to help you with that business plan, like the SBDC or the Women's Business Center, or any of those BBOX centers that can help you with your business plan and figure it out. So that's what that relationship looks like. So let's talk about a couple of solutions. If you're challenged in this area, first of all, if you're not using a credit card, get one. You're like, Sabrina, I've been declined. I have challenge credit. They won't give me one. Well, consider a secured credit card. It just means we don't trust you, but it doesn't mean that we won't give you a chance. So right now, I'm gonna give you an example. Fulton Bank has a secured credit card. If you put $300 down, we're gonna hold that as collateral. You have $300 that you can use on your card, and you can start either reestablishing credit or building credit that way. Make sure you use it, pay it off. And the great thing right now, because of COVID, Fulton Bank is not charging a $39 annual fee for you to have this card. We are understanding the pain points and the challenges of our industry, our economy, and we're here to help people because there's so many people losing their jobs right now. There's so many reasons why credit scores might be challenged, and we get that. So we're waiving the annual fee. We are not even charging an annual fee for you to help rebuild your credit or establish credit in a very challenging time. So that is an example of a product that we have going on right now. You go to Bank of America, they charge you $39 a year, you know, but they have the secured credit card. If you go to Wells Fargo, they have those products too. So I just want to let you know that's an example of how you can fix this category. So I'm going to give you another example. Remember, I gave my daughter the right to be an authorized user of my $10,000 credit card, and it helped her credit. Well, just keep in consideration on this example. Let's say you have a $5,000 limit. You've got Fulton Bank, Bank of America, and Capital One, and you are over $1,500. Let's say you're at $1,500 and you're like, well, how can I fix that without having to go get another credit card? Well, you can have a family or friend add you as an authorized user. In the example, like my daughter, when I added her to my $10,000 credit card that I did not have a balance on, throw in that amount for your limit in this example. So in this example, you had $5,000 limit. You add my $10,000 limit to that. Now you have $15,000. And you're under 28% utilization. That will increase your credit score by 30% immediately. This is the fastest algorithm. It usually, all the algorithms want to know, average out what you're doing. This is the fastest. Usually within 90 days or less, you'll see your score reflecting 30% increase immediately. And I hope that makes sense. The other option is call Bank of America or Fulton Bank and say, I know you gave me a $2,000 limit. I want to increase it. I want to up it. And there's an opportunity for that. Or you can open another credit card. Let me give you an example. Hear me when I say this. Credit cards were never meant for long-term financing. They are only meant for short-term financing. That's why the credit bureau gives this a high value of your score. How do you manage your credit cards? Or are you using them in a capacity that they were never meant for? That's why it's 30% of your score. You got to get this right. Credit cards were never meant for long-term financing. They were only a short-term solution. So what do? Do a debt consolidation. Pay off your credit cards. Don't close them out. We're going to talk about why. And fix how you're using them. Because as soon as you start using credit cards correctly, then your score increases. So I'm going to give you a commercial. Right now, Fulton Bank has a 15-month, no interest, business credit card, no annual fee. And you don't even have to show proof of income. We don't ask you for any documentation. We take your word for everything you're telling us. And you can get up to about $35,000 approval. Does that sound pretty easy? Yeah. Just because you can doesn't mean you should. I'm going to repeat that one more time. Just because you can doesn't mean you should. is it a good solution if you need maybe $20,000 or less and you have a strategy in 15 months that you're going to pay that off, and you really are focused on that, and even if you get to 2 years, by 2 years you've got that paid off, okay, max 2.5 years, that's the way to use the credit card. That's a loan, that's 15 months, no interest, no fee. I mean, who's got that? You can't go out there and get a business loan for that. So yeah, if you have some supplies or something small that you need and you've got a good strategy and you're going to pay that off, and even if it's not paid off in 2 years, then you're going to go back to Sabrina at Fulton Bank and say, now I need to pay this off. Let me do a business debt consolidation and put it on a loan. That's the right strategy. But if you are the person that needs $100,000 to start your business, and you're going all over town to get $100,000 in credit card debt, you're gonna lose. It's gonna bite you. And it's gonna bring your score down if it's personally done that way. So my point in saying that is use it for the right purpose. Come up with the right strategy, sit down with your banker to understand what that strategy is, or just come see me, we can figure it out together. All right, so moving right along.
Sabrina, there are 2 questions. Do you want to get those 2 questions before you go to the next section?
Yeah, let's do it.
Okay, the first question is from Jeanette. My extent of credit right now is my car loan, and I'm about to pay that off this month. What can I do to help me obtain a credit card?
So can you repeat that first part again?
The extent of her credit right now is her car loan, and she's about to pay it off.
That is a loan, right? Okay, and then she's wanting to know, how can I get a credit card when I pay off the car loan?
What can she? Okay,
Correct.
To help Jeanette?
Hi, how y'all doing?
Good, how are
There
you?
she is.
I'm good. Yes, ma'am, Miss Sabrina, that is my question. The only credit I have right now is my car loan. I'm about to pay that off. And I haven't used a credit card or any other credit in over 10 years. So I'm just trying to get back on board.
You're that customer I was talking about.
Yes, ma'am.
I mean, we have, for everybody on the call, we haven't met. I'm just poking fun a little bit. But yeah, she's a great example of, okay, I haven't used credit cards in 10 years. And now you're realizing that's 30% of your score, which is a huge impact, right?
Yes, ma'am.
And I appreciate you, being out there and being transparent. So yes, if your score is a good score, and of course, I know I usually get a question of what's a good score, we're going to get there. Then, the secured credit card is only for someone who's got a challenge score or a challenge situation. So, maybe what you do, if you're a client that doesn't need to go in debt for any reason, there are, like example, and I'm, Tasha, please close your ears. Here's another commercial. Because I don't want people to think I'm trying to sell something. I'm giving you examples so you can get out there and search and figure out what's out there. So we have a 5% cashback rewards credit card. And that's how I use credit. I'm going to give you me as an example. I put everything on my credit card that I was going to pay out of my checking account, any bill, anything that I can, because it was going to be coming out of my checking account anyway. I had that money earmarked for those bills every month, and every month I pay it off. Let me tell you, I make about $600 or $700 every year cash from just using my credit card that way, because it pays me. And, at the end of the day, they made the game. I just play it. I just play it well. So I make money off the credit card, and that's how I use credit. And it helps build my credit history. So then my score is continuing, to climb and all of the above. And then we have the personal credit card that's 15 months, no interest. So if you want to do a debt consolidation and we come up with a strategy, that's another option on a credit card. Then there's the travel credit card, if you travel a lot for your business or whatever. So these are different ways that you can help build credit. So with us, basically, to do a credit card, it's just a phone conversation, but I would really like to have a conversation with you on the right one and the right choice for you. So I hope does that answer your question?
Yes, ma'am, it did. We're going to be talking. I'm coming to see you, Miss Sabrina. That's happening.
Fantastic. Well, thank you. And thank you for the question. That's really great, because please ask your questions, because I've done this particular presentation for a few years now, and your question, believe it or not, can help somebody else that's not thinking, or maybe is thinking of it and they just don't want to go put it out there. But I promise you, you're helping somebody else with the questions that you have.
Yeah.
So great question.
Yep. So what I'll do is we'll wait until the very end, because keep putting the questions in, and we'll try and get as many answered at the end. So I want you to go ahead and finish to get through, and then we'll have a lot more time at the end to answer the questions. So
Yes, ma'am.
Pin in it, and we'll go ahead and let you finish.
Thanks. All right. So the 30%, we talked about what you can do, open a new credit card. We just talked about a little bit of what that looks like. Call the existing credit cards and do an increase on the limit as an option. Ask a family or a friend to allow you to be an authorized user on one of their credit cards. Now, be careful. In my example, if I gave my daughter utilization credit history in that one card of the $10,000 that I told you about, but I have a balance of $9,000 on that card, I am negatively impacting her credit, because her utilization is going to be jacked up, because with my balance of $9,000, it's over 28%. So make sure you're asking the right person that pays on time, that's not extended and on their balance, to add you as an authorized user. Be careful that if you are going to do that route, that you're asking the right family or the right friend, and it's going to take a transparent conversation. And in some cases, I have had a situation where they came to see me, and we got the person on the phone that was considering making them an authorized user, and we kind of discussed it and talked about it. And, then they left there and made their decision whether they were going to do it or not. So the other option is, at the end of the way, pay it down. Pay your balances down under 20, your balance down of 28% or less. Hey, do that. It's a budgeting technique, and then you can make sure that you keep that particular algorithm where it needs to stay. So moving right along, 15% goes to your length of history. So remember when I said don't close the credit card when you pay it off and do a debt consolidation? When you close the credit card, you wipe out your history, and you don't want to do that. Again, if you close out the credit card, you wipe out that history. That's why some of my elderly clients come to me and say, I cleaned everything up. I haven't used this since, 20 years from now, and I closed down the credit card. But my score went down. I don't understand why. It's because they wiped out their good history on that credit card they used to have when they closed it. So don't close down your cards. This is the time elapsed since each account has been opened. So the length of history is important. So here's the other deal you need to know about this. They average all of your credit cards, loans, mortgages, HELOCs, anything that you've had reporting on your bureau. They average the time together. So if you've had a credit card for 20 years, and that was your first credit card, it does not mean that your credit history says the length of history is 20 years. They take that 20-year credit card, the most recent Victoria's Secret credit card that you got to get 20% off of your purchase. They take everything, average it out, and that's where the number comes from. So how can you fix this one? And keep in consideration, it's only 15% of your score. So keep that, it's all relative, in the back of your mind. You can piggyback on somebody's length of history as an authorized user as well. So remember that 20-year credit card that I had for $10,000 that I let my daughter piggyback on as an authorized user. She then piggybacked on my 20 years of history that I had with it. The other thing, if you are the customer that you are going to not use the credit card forever and ever, amen, and you're like, I really just want to get rid of it because it's got a $20,000 limit on it, I'm never going to use it, I really don't feel comfortable leaving it on there, then call the credit card company and ask them to decrease the limit instead to maybe $5,000 or $2,000. Be careful, because if you decrease the limit on your cards, make sure you're keeping utilization in consideration. Don't be over 30% if you have that balance or that limit, not the balance, but the limit decreased. Next one, 10% is the type of credit. So remember I talked about paying off your credit card and doing a debt consolidation. Well, if you pay off your credit card, get it down to less than 28% utilization, and you do a debt consolidation and put that on the loan, you are then increasing your score by 40%. You're like, what? You just blew my mind. What happened? So I'm going to talk to you about how you get 40% when it comes to an increase of a debt consolidation for your credit cards. Heaviest weighted in this category is your mortgage loans. Second heaviest weighted is your car loans, secured loans, and unsecured loans. Any fixed payment, fixed balance, and at the end of the day, it's paid off, it goes away. Third heaviest weighted is lines of credit and credit cards. So if you're taking your limit or your balance off of the credit card and doing a loan, you're taking it off of number 3, least heaviest weighted, and putting it on a number 2, which is on a secured or unsecured, and it's basically an unsecured request, and doing a debt consolidation. Yes, Fulton Bank does debt consolidations. A lot of credit unions are a great resource to do debt consolidations. Check with your bank to see if you know they're making you happy, to see if they do get debt consolidations. It's going to save you money in the long haul. I have some clients that use like that 15 months, no interest, balance transfer, no fee to do a debt consolidation. You know, it's all about what's the right strategy for you. So in this particular situation, that will increase your credit score by 10%. And then you're paying off your credit card. So that's 30%. So the two of those added together is 40%. That you're increasing your score. Huge. 10% goes to inquiries. So this is the number of times that you've pulled credit and done an application. So there's hard pulls and soft pulls. Hard pull means that you are going to get a letter in the mail, and you're going to get an approval or decline, and you're going to get whoever they pulled the credit bureau from, and they're going to get your score. A soft pull is like you open an account with Fulton Bank. We're doing a soft pull. Utilities, they do a soft pull. These Credit Karmas and different programs there, they're doing a soft pull. And it does not stay on your bureau for more than 30 days and it falls off. So it's not a hard pull. So how many inquiries is too many inquiries? When you get to 7 to 10 inquiries in 18 months, you're in the yellow. If you're under 7, you're still in the green. And remember what I just said, it's not 12 months, it's 18 months. That hard inquiry is going to stay on your bureau for 18 months. A common misconception is that the inquiry is only going to stay on my bureau for 12 months. What's great about Credit Karma, you don't have to figure any of this out. They figure it out for you. They'll tell you where you are in your utilization. And by the way, they're free. You don't have to pay anything to do Credit Karma. They'll tell you where you're at in your inquiries. They'll even tell you the month and year that inquiry is going to fall off. They'll even tell you if you're in the green zone, the yellow zone, or the red zone. They'll even give you examples of what you can do to increase your score if you're in the red zone. A really great program, and a lot of reasons why I like it. So remember I talked to you about how we are going to talk about, what's a good score, what's a bad score, what's a challenge score. So this is not from me. This is myfico.com, and they're giving you the national average. 680 and above is going to give you the best pricing. 620 to 680 could be a decline or an approval, but if it is an approval, typically you're not getting the best rate. And then, of course, 620 and lower, you're probably going to find a lot of declines in that area. So this gives you an idea of what a good score is. These are ways you can improve your score. Annualcreditreport.com, we talked about that. Correct your credit report if that's the situation. What's great about Credit Karma is they have a little link on the side that you can just hit dispute. You can go to annualcreditreport.com and dispute anything that is not right on your bureau. Pay your bills on time. Number 2, payments, bill pay. Let me give you an example. You can use your bank as a strategy to budget. You can use your bank as a strategy to budget. Well, Sabrina, how do I do that? Well, I'm going to tell you. I personally bank in a situation to where I have a checking account for Christmas, I have a checking account for vacation, I have a checking account for my cars, I have a checking account for paying bills, I have a checking account for my savings. I also have a checking account for my grandchildren. So you can guess by now that I budget and I prepare for the expenses that are coming up. And I know I spend a certain amount of money for Christmas every year. And I take that money out of my paycheck and put it in that account. So November comes, I'm ready to go shopping, and it doesn't have to be a stress. And I'm preparing for that expense and not borrowing for it. And that's tough to do, right? If you are dealing with a bank that charges you a fee to have a minimum balance in there, because in order to budget that way, you need to choose a bank that does not charge a minimum balance fee or monthly maintenance fee in order to have a checking account with them. And here's another commercial. Fulton Bank does not charge for any personal checking accounts or any business checking accounts. And on the business side, if you, say you're that landscaping company, you should have a payroll account that pays payroll. You should have a merchant services account that's a way for people to pay you using debit card, credit cards. And then you should have an operating account. Your CPA is going to love you. You can budget effectively. And if you're an investor, let's say you do flipping houses or you rent houses, maybe you have an account for each one of your houses. So it helps you budget and see where your money's going, but you got to choose the right bank to be able to do that. Just come to Fulton. So moving right along, understand how your score is determined. You can cross it off your list because we just did that. And you can repair your own credit now that you know how the algorithms work. There's nothing that a credit repair company can do. And I know it says repair scams. It's not a scam. It's just a place of business, right? They are there to help you repair your credit, and they're using these algorithms to be able to do that. But maybe you're the client that didn't want to go through repairing it. You don't want to go through the painstaking time it's going to take. So yeah, go pay somebody that does it as a business to be able to help you do that. But I'm just here to tell you, you can do it yourself. There's nothing they can do magically, twinkle in their nose, waving a wand, of calling and helping you repair your credit that you can't do yourself. And you're saying, well, Sabrina, they called and they negotiated. Well, so can you. You can call and negotiate as well. This is a gift that I'm giving you from an attorney. If you're paying off a judgment or paying off a collection, write this on the back of your check when you're sending them the last payment or the whole payment, and they're supposed to take that and take it off your bureau once you've paid the debt. This serves as a receipt legally. You can go back to your bank, get a copy of the front and back copy of your check once they cash it. It is a legal binding agreement that they have got to clear the check. Once they clear the check, the payment settled all claims by the creditor against full and creditor further agrees to delete all derogatory credit information. So, you know, you can't go and a lot of times get a judgment receipt that you paid it off or a collection receipt that you paid it off. This is a way that you can get your receipt. So with having said that, let's go right into the next presentation, which is let me get this up. Reach out to Tasha if you did not receive this presentation for Participants Guide from SBA. This is a very quick, we're going to spend about 5 minutes on this. This is how for you, anybody that's on this call that they want to understand how to build business credit. This is a nice, neat little packet that kind of explains how to do that. On page 8, and let me make sure I get there, that's 6. 7, number 8, business credit reports. There is a different score for your business credit, and these are some things that you want to keep in consideration. There are 3 national business reporting agencies. That's the Dun & Bradstreet, Experian Business, and Equifax Business. Most banks use Dun & Bradstreet. You can go directly to Dun & Bradstreet, and for a fee, you can pay them to help build your credit. Or you can do it yourself, and this is specifically for your business credit score. So some things that you want to know, you know, there's commercial credit risk scoring, if you've paid on time or not paid on time with any business debt you have, any other business ownership that you have, public records of interest filings, summary of any financial institution reporting on how you're paying, scores from other reporting agencies, your payment trends, payment index comparisons. I know it's a little bit more in detail, but that's why Dun & Bradstreet is kind of a subject matter expert to help you be able to build your business credit score. Because when you go to the bank or credit union, you're applying for a business loan, we're going to pull both scores. And you want to be able to have, you know, a strong score. You can have a strong personal score and not quite as strong of a business score because you're startup business or whatever, and we still will approve you at Fulton Bank. So, but I wanted you to be aware there is such a thing, and we do look at both. And just reach out to Tasha. I think she sent it to everybody. If not, she will send it out to you. And Tasha, I'm not sure if you're still there.
Yes, I'm still here. Everyone that I've checked in, as long as I can identify you, I've checked you in, and you, if you have not already received it, Deborah will be sending it out afterwards.
Okay, very good. Well, that gives us about a half an hour for questions and answer session. I wanted to give us enough time. As you can tell, I didn't spend a whole lot of time on your business credit. That is going to be your homework. And with that pamphlet, because it just takes a little bit of understanding and reading, it's not really that hard. If you're the client that doesn't want to do all of that, just reach out to Dun & Bradstreet and they'll help you build your credit score. Not that, I mean, I'm not advocating you do that. You can build it yourself. So I don't want you to think that I'm like, yes, I'm selling something from Dun & Bradstreet. Absolutely not. You can do it yourself, and that booklet will give you an idea. And if you have any additional questions, let's just reach out to me by email or whatever, and I can point you in the right direction.
Okay, so one of the first questions that we do have is, will filing bankruptcy for my personal debts hinder me or my business partners from obtaining a business loan? That question was from Nicole Mitchell.
So, will filing bankruptcy for personal debt hinder me or my business partner from obtaining a business loan? Yes. And I know that's just short and sweet and to the point. You'll always get that with me, very transparent. I would encourage you to meet with me before you make that final consideration. The backup to this question also is how long after bankruptcy can I go ahead and apply for a business loan is usually what I get. If you are filing a bankruptcy or you're in the process of it or you've already done it, please don't be depressed. Don't think that there's nothing that you can do from here on. What I would want to do with you is a very strategic plan to rebuild credit. So, what is a bankruptcy? Basically, it's saying that I can't pay my debts. No judgment for whatever reason, but at the end of the day, we can't trust it. So therefore, we're not going to give more credit out there to somebody who just filed bankruptcy until they have shown that we can trust them again. And how do you show that trust? That's by rebuilding the credit. And there are strategies to rebuild that credit. I don't want you to get discouraged. So if it is the right solution for you or that person's family, I get it. I know it's not easy to make that decision. If you haven't made that decision, just reach out to me and we can discuss details of, is it better to clean it up or is it better to go bankrupt? And of course, I'm not going to tell you what to do, but we can talk through it together and what that means. Great question.
This next question I would like to ask Cherie P. If you don't mind, can you unmute yourself for me and ask this question live, please, if you don't mind? You don't have to show your camera, but it's.
Is this about the credit card?
Yes, if a credit card offers no annual fee and no interest rate for 3 years, but a loan has a high interest rate, opening the loan and having to pay more money back is what won't hurt our score, but the no interest card will. I'm not sure of the question.
So earlier you were explaining that there's different tiers of credit. The credit card is the lowest one, and then the loans are the second tier, and then your mortgage is the top. So, and the example was to use the second tier of a loan instead of using the credit card, because the credit card is the worst type of credit or the most harmful to our scores. But often when you get an offer in the mail and you have a 0% interest rate, no annual fee, of course that credit card is going to be the best option for my 3-year plan versus a loan that I'm going to be paying a high interest rate on. So it's kind of like setting us up for failure. And I'm wondering if you have any feedback about that.
Yeah, and I'm glad you asked that question because I think there's a little bit of confusion probably on the way that I said it. So let me give you clarity. So the answer to your question is, do I do a loan at a higher interest rate or do I do 0% and I have a strategy to pay that off within the time frame that it's 0% and not want to just keep that balance and on and on and on? Absolutely. That's a great strategy. I would highly recommend it. It's going to save you money because at the end of the day, it's about saving the money, right? So what I don't want anyone to do on this call is get hung up about what you do or you don't do on any of the credit algorithms if it means it's going to save you money. Like if you're doing a secured credit card and I've said, don't close it out, but you're paying an annual fee and you need to be, you're ready to take the next step. In other words, you are not needing to stay on that credit card that's got a $39 annual fee because you've built your credit. Now you need to be rewarded. And that means, well, no, I don't want you to pay that $39 fee just because I said 15% goes to the history. That just means you've built an established credit and you should be able to move on to the next step. And you're going to save that $39, but you're also going to get a better credit card opportunity. They're going to give you your money back. You don't have to use collateral anymore. It can be unsecured, and maybe it's the 15 months no interest. Maybe it's a cashback strategy that you're using, and move on. So if it's about saving money, absolutely, 100% you're right. Save the money. Keep in consideration, please understand, I'm not saying that using credit cards is a bad thing. And I'm not saying don't use credit cards because they're a bad thing, because they're a good thing. They serve their purpose. What I was saying and want to reiterate is credit cards were never meant for long-term financing. So if that's your mindset, I would encourage you to consider a different mindset and consider a loan if it's for long-term, more than 2 or 3 years that you're planning to have that balance on the credit card. And consider a loan with a strategy that has a fixed rate, fixed payment. At the end of the day, it's done. But what I don't want you to do is use Peter to pay Paul, and it's just this revolving cycle of continuing to build up credit card debt, because although she was mentioning, and please forgive me, I just forgot your name again.
Sure.
Sheree, thank you. And I really do appreciate the question. She was using an example of the 10% algorithm, which is heaviest weighted is your mortgages, second heaviest weighted is your loans, third heaviest weighted is your. Keep in consideration, I wouldn't focus on that algorithm as much as I would on the 30% algorithm, which is, hey, great, you have credit cards, but are you using them properly? Stay under 28% utilization, because that can negatively impact your score more so than the 10%. And I hope that kind of answers your question, but you're right. You should
It
not,
does.
if it's going to cost you more interest and not, you could do the credit card and save the interest. Absolutely, 100%.
Well, that's kind of the situation that I'm in right now. So I have one credit card that's $5,000. And when I needed a car, knowing that it has no annual fee, no interest rate, I use this credit card to purchase a used car. I didn't want to take out a loan, which I could have, that had an interest rate. So my other credit cards are all under $500, which I have under 5 credit cards. So now my credit score is low because of that high balance credit card being used all the way. And it's hurting my score more than having opened a loan, if that makes sense.
It does. And the first question I would have, and we can do this one off, but I want to go ahead and kind of point you in the right direction. The first question I have is, and you don't have to answer this, but how long is that 0% on the credit card? And then what's your strategy after that? Is it going to be, let me jump into another 0% credit card? Because 5,000 is 5,000, and you may have a strategy to pay that off, and that's great. But until you get under 30% utilization or 28% utilization of that card, and that's the only one you have, it's going to be a challenge for you to get any additional loans moving forward, because the score is going to be challenged, and you're 100% right.
Okay. Thank you.
Yeah, you weigh the pros and cons, and then you figure out, well, hey, I don't need any credit right now. I'll just use this platform. The other thing is, maybe you have someone as an authorized user to bring your score back, up again, or maybe it's time. You got that 0% and you were approved for that. So that tells me your credit was pretty strong. So maybe you just use another credit card to balance that utilization out, or an authorized user to balance that utilization out. So when you are ready to borrow again, you're prepared, even if you know that's going to be today or tomorrow, or just have a good strategy to get that credit card paid down to 28% or less. But I'm glad you used that as an example, because that's a great example of, okay, I'm perplexed because it's a catch-22. I'm getting a great rate, I'm saving money, but it's bringing my score down because I'm over 30 or over 28% utilization. And that's just kind of how it all works. It's not fair, but it can be fixed.
All right.
Okay,
Our
thank you.
next-
Thank you.
Okay, our next question is, if we have no business credit, would applying for a secured business card, would we apply for a secured business credit card?
So yes, you can apply for a secure business card, and that will help establish business credit. Doing any kind, I mean, whether it's so here's the thing, I wouldn't even do the business credit card unless you don't get approved for a unsecured business credit card, because if, why pay an annual fee if you are having to pay it, or why pay the higher interest? Just because you don't have a built up business credit score doesn't necessarily mean you're going to get declined. I would encourage you to seek out whether or not you have to do a secured business credit card, and first understand if it's going to, the first step is to see if you can't get the unsecured one. In most cases you can, unless if the personal credit bureau is challenged and you don't have any business credit, then yes, the secured business credit card is the way to go. But if you have a very strong personal credit score and you don't have any business credit score, then you can still get approved for an unsecured business credit card. I hope that makes sense.
All right. The next question is, should apartment rental places make hard pulls on your credit?
Unless you signed an agreement with them that you were okay with them doing that, they should not. They have to be, they're regulated. If there is any business that is pulling your credit score, not score, if there is any business out there that's pulling your bureau and it causes a hard inquiry, they are regulated to send you a letter saying, here's what your score was, we pulled your credit, and here's the bureau. But you have to agree when it comes to an apartment complex. There's a document they have to get you to sign that you're aware that they're going to pull your credit and you're okay with it.
Okay, very good.
Good.
Good questions. All right, next, Brandy Butler, can you unmute yourself, please? I want to make sure that we're answering your question, because I think it was during the conversation that you were asking the question, but then you also had an additional question that was with it. So can you ask your question live, if you don't mind? You don't have to hit your camera.
I think what was the other fee we wanted to charge with the banking accounts? Yeah, so what's the other bank fee we want to avoid? So minimum balance requirements or a monthly maintenance fee? I think that's what he was asking.
No, is she still here?
Brandy? And maybe you.
Yeah. She's on mute.
So banks, if they, you want to ask them, do they charge a monthly maintenance fee? Some, regardless of what balance you have, you're going to have a fee monthly. Some waive that fee if you have a certain balance. So you want to ask about both. And not only that, you also want to ask them how many transactions they give you. Like, example, Fulton Bank, we give you 200 transactions a month. And if you go over that, there is a 20-cent fee for each transaction. So we talk about that up front. And if you're not getting transparency from that bank, and unfortunately you have to go do your own research, it makes me wonder if you should do business with them. But you want to definitely kind of take a deeper dive. You want to ask, how many transactions do you get if they're not charging a fee per month? You want to ask if they're charging a fee for a monthly maintenance fee, and is there a way to waive that monthly maintenance fee if they have a minimum balance requirement that you reach, if you want to choose to do business with a bank that has all those fees? Good question.
All right, we have another good question. And let me get back to it. trying to find it now. All right, are accounts that will be paid off within a year and is being paid as agreed looked at as part of your debt ratio?
Yes, they are. So, and I'm trying to find, I'm in your chat room now. I'm trying to find a C. Brandy's.
It was a direct message to me.
Oh, okay. I'm like, wait, I don't see that one. So can you repeat that one more time?
It says, are accounts that will be paid off within a year and is being paid as agreed looked at as part of your debt ratio?
Yeah. So debt to income ratio is a number we come up with. Basically, we take all of your debts divided by all of your income, and then if it's over a certain percentage, it's risky to the bank if it's over, like, say, 55%, because we take a part of that also as household expenses that's not on the bureau, and we give you another 30% that we add on top of that. And then if it's too close to, okay, you don't have a penny left over to your name after all of that, then it could be a decline based on debt to income ratio. But the question is, you have a loan, you're paying it off within a year, and will that be considered? So there are several answers to that question because it depends on the type of loan that you're applying for. If you're looking to do a mortgage, a lot of times if there's a term, like under a year left, they don't count it against you. Some banks, if it's under $1,000 that you owe, they don't count that in your debt to income. And then, like mortgages, they usually are a little bit more lenient when it comes to that. But typically, a bank like a car loan or not from like if you're going to a car dealer and you're applying for the loan, they basically will try to, figure out every way they can to get you a loan. But if you go to the bank and ask for the loan, we take all of that in consideration. So it depends on the type of loan that you're applying for, I guess is the answer that I'm trying to give, because it's a moving target on that answer.
Okay. All right.
Great question.
The next good question is, please explain why credit card companies lower your limit when you don't use them.
Why credit card? Oh, well, it depends. The answer to that is calling the credit card company and asking that question, because it could be a lot of different reasons. It could be that when you do a credit card, they are looking at your credit every year. Sometimes if the credit is challenged, they'll just shut it down on you. And they have that right because you signed it in the agreement when you accepted the credit card approval. But most of the time, if you're not using it and they shut it down, it costs that company money to have a credit card for you. There's a cost of doing business. They'll send you a new credit card every year that it expires. They're mailing things to you. They might be, having to deal with disputes. They might have charge-offs or fraudulent events. So there's a cost of doing business in order to have a credit card with somebody, with an institution. So that institution may see that they're not making any money off of you at all, or you're not using it as far as no activity. So then they will not just shut it down on you. What they do is they send you something in the mail and ask you if you're still interested in keeping the card. Please give them a call by a certain day. And you want to call them and say, no, I want to keep it open. But if you want to decrease the limit, you can ask them right then and there, decrease the limit. It's not that they want to shut it down on you because you're not using it. They're asking you, hey, you haven't used it in years or however long. Are you still there? Do you still want to use it? Otherwise, we can shut it down and it'll save us money not to have to keep sending you renewal credit cards, or that you haven't activated any credit cards in the past So they'll ask you, do you still want me to keep it? But if they shut it down without asking, it's because there's payment issues going on there.
Okay. All right. And our right now, our last question that we have is, how does high student loans, $100,000 plus, play into these calculations of debt to income and getting approved?
Do you know, I get this question every time I do the presentation, and I love it. I'm really glad you asked, because there are so many people that are dealing with student loans. Hopefully our new president will start to relieve some of that, I'm hoping, with his promise. And I think he's talking about relieving up to $10,000 of student loan debt that's been out there. And of course, they're trying to put their arms around the regulation with that. So the answer is, when you have student debt, student loans, we look at it two ways. Is it in deferment, or are you paying it right now? So if it's in deferment, we look at approximately what that payment is going to be when you're out of deferment. And there's two debt to income calculations that we look at. The front end, okay, this is what the debt is, this is what our payments are going to be, and the back end. The back end is if there's any student loan payments that are in deferment, what's going to be that payment at the time. And if they max out every single credit card that's out there that they have, what's the payment going to be? That's the back end debt to income. The back end debt to income is not necessarily a decline reason, but if you're on the border, it could push us over to decline you. That's why you don't want a ton of limits out there that you're not using. And not that I'm advocating that you close them down, but you can call the institution and decrease the limit. Because if you're getting that in a decline, it just means, well, there's late pay and you have too much open revolving credit is the exact word they'll use. But it's usually not the decision maker for decline. Usually there's a couple of things that are just right on the cusp of decline and maybe an approval. But if there's a whole lot of open revolving debt out there, even if it's at a zero balance, it could take us to a decline. So that's a great question. So if you have student loans and you're paying it back, it is considered in your debt to income.
All right. Are there any more questions?
You guys are awesome. These are great questions. All right.
Well, I have now entered the next workshops that are coming up into the chat as well. Thank you all for your time and being here. Thank you, Sabrina, for your time and your expertise and your knowledge and sharing with us as you do. The next event for Sabrina will be how to finance your business venture. That will be next Tuesday at 10 a.m. Same place. If you can just register in Eventbrite, I put the link into the chat. Make sure you please do register. And also, we will be getting the brochure out, or the pamphlet out to you after the event. As long as your name is appearing on and I can identify who you are, I've checked you in and we will get the information out to you. The video is being recorded. I'll have to edit it and then it will be uploaded into YouTube. And we do send out, as long as you're on our mailing list as well, we'll send you the link showing you where you can find the video, which will be on YouTube. So make sure you subscribe to our YouTube channel and all of our social media outlets out there as well. I'd like to thank you all for coming today, and until next time, see you later. Bye.